Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by CommercialAgentSuccess.com. Check it out for the ultimate in training for commercial brokers. Learn more at CommercialAgentSuccess.com. Well, we have a great show for you today. I think there's a lot of question today in the market. Here we are at the end of the first quarter of 2023. We have interest rate spikes that have just happened. The Fed's talking about maybe raising rates more, or they are talking about it. There's a looming potential recession. Maybe that's what the Fed wants to kill job growth and potentially help with inflation. So there's a lot of question marks. We also have one of the major sectors of office from the COVID issue, where folks aren't working as much in the office. So what do investors think? What do lawyers, people in our industry that are in asset management or institutional investors, what is really the sentiment out there of what to expect moving forward? Well, we have a treat for you. Please welcome Ron Gard. He's a partner with Seyfarth Shaw, and he's joining us on video. Ron, good to see you, sir.
Good morning.
And they do an annual report, and I have a copy here. We'll have a link on the show notes. It's the 2023 Real Estate Market Sentiment Survey. They've been doing this for 8 years. They send the survey out to 2,500 commercial real estate professionals, including some of the folks I talked about earlier. Now, to keep in mind who Seyfarth Shaw is, they're a big law firm with offices all over the country, and also in China and Australia and England. They have offices where I am here in Atlanta. They have them in New York. They have them on the West Coast. In fact, they have 130 real estate lawyers. Their website, if you want to check them out, is Seyfarth.com, Seyfarth. Well, let's get into the survey here, Ron. And as you have been involved in this, I want to go over, there's really kind of 13 major questions. I think they're all fantastic to kind of get the highlights of what you garner from this survey on these 13 questions. But first of all, when you look at this survey, you look at the results that you got, what's the kind of the overall sentiment? What did you get at as a kind of a big picture?
Well, I guess the and you phrased this in past years as the takeaway, and I think you hit the very first takeaway is that there was an unbridled sense of opportunity for 2023, and it's 69% of the respondents saw this year as a year of opportunity as opposed to retrenchment. And that struck us, just as an aside, given the context. And the context is really looking at 2002 with slower growth, rising interest rates, discussions certainly, and fears about a recession, as you identified, pullback by commercial lenders, and expensive derivatives market if one were to try to obtain loans, major tenants shrinking footprints, some slowing growth, some layoffs. So you've got all this, we'll call it negativity out in the marketplace. So our expectation was it not to be this substantial in terms of seeing 2023 as a year of opportunity, when in fact the latter part of 2022 really was a year of retrenchment. And going into January of this year, enough out there to say, okay, we would expect more retrenchment, certainly for the first part of the year. So now we're trying to analyze where this sense of opportunity is coming from. And again, Michael, at least our thoughts, is it may or may not be that they are optimistic. I'll say that they're more opportunistic than optimistic for the year. And we've discussed this in the past. Generally speaking, the folks in commercial real estate are an entrepreneurial bunch, generally optimistic by general standards, but also looking at the year, certainly the first part of the year, they did see a slowing of growth. They did see a moderation of inflation that may have changed, as you know, since in terms of what the Fed's looking at in terms of future rate increases. But there's also some correlation, we think. One of our other questions was, in the survey is or was, are you intending to invest in distressed assets? And we got a surprising number from our perspective of 48% looking at distressed assets. So if you take opportunity, you take the economic background, and you take distressed assets, you can see with some correlation that may be a basis for opportunity in 2023.
Yeah, that is amazing. When you look at 69% thinking it's a year of opportunity versus retrenchment. And I like your point. And I had a couple points I think that we're hearing from some of our clients is, you might be able to get into properties at a better basis, right? If there's less buyers, the financing costs are higher. And as a long-term hold, which most commercial real estate is, you may get in at a better basis. You may have better opportunities, less competition. And then maybe some folks that have been around for a long time look at it as, well, maybe we're into more normal rates, right? More normal interest rates. And talking about interest rates, let's look at question number 2. And that was, hey, over 2022, the Federal Reserve raised rates by 425 basis points. And then the question was, how do you anticipate the Fed will increase or decrease rates during the course of 2023?
Yeah, and clearly on a net basis, 82% believe that interest rates will be on a net basis higher than they were in the first couple months of the year. And based on what we're seeing real time, that seems to be accurate. I think there could have been some expectation that by the end of the year, the fourth quarter, rates could be reduced. We'll know in the next couple of weeks, frankly, whether that's more or less likely to occur. But clearly the sentiment was, and is, that interest rates would increase on a net basis for the balance of the year. And if you recall, well, you may not recall, in 2021, in our survey, the estimate was that if interest rates increase by 100 basis points or more, that would have a material adverse effect on the real estate market. And sure enough, as we saw in the third and fourth quarters of last year, and I think we'll see the numbers for the first quarter, that would be an accurate conclusion.
Yeah, I agree. And, I own a shop here in the Southeast that has brokers focus on every property type. And it's interesting where we're seeing pricing land at higher cap rates on these investment properties, but very different for the different sectors. It's pretty amazing. And that brings us to question number 3, which is on a lot of people's mind. Do you believe there will be an economic recession in the U.S. in 2023?
Yeah, and the answer is without a doubt. I think 71% said we'd see it in the first half. 88% said we'd see it certainly through 2023. But probably the most surprising takeaway, if you will, is that 37% of the respondents already considered the real estate community to be in a recession. And that's to distinguish from the general economy. And again, if we've talked about, we see tenants that are shrinking, high vacancy rates, low occupancy rates, obviously. Questions about folks coming into the office. You've got high derivative costs, high interest rates. You've got all these factors that affect commercial real estate now, and including increased costs that carried over from whether supply chain issues or otherwise inflation. So that you see the net effect on commercial real estate being so negative, going back to the earlier point about interest rates as well, having a material adverse effect on commercial real estate. And you can see that many folks believe that we're already in a recession in the commercial real estate sector.
Well, it's interesting to hear that because it kind of correlates back to kind of question number 1. If a lot of your respondents believe, as far as commercial real estate, we are in a recession, and then maybe that makes sense for their idea that this is 69% of them believe this is year of opportunity, right? Hey, we're already here.
Yeah, and let's not forget that there's the old adage, and I presume since it's so old and so used, I assume it's true, that real estate is a hedge against inflation. So if you're already in the marketplace, then you can identify that either current assets that you've got or assets you're going to pursue are in fact going to be more valuable, certainly towards the end of the year. And again, give them an opportunity for investors.
Yeah. And of course, one of the questions investors have is when the market's doing well or there's a downturn, is how long will it go? So question number 4 is, how long do you think the recession will last?
Well, good 73% expect the recession to last for at least 6 months. Only 25% expect to last greater than 12 months. And our analysis is that the 2008 Great Recession lasted 18 months. So on balance, you could say that at least our respondents believe that the recession will be short-lived, put that in quotes, air quotes, as opposed to the long-term 18 months, which really did have a detrimental effect on our economy.
Yeah, and maybe that's another reason why folks think that this might be a year of opportunity. We're talking with Ron Gardy, a partner with Seyfarth Shaw, about their annual sentiment survey of commercial real estate professionals. And we're at number 5 here, which we kind of touched on briefly already. Do you anticipate investing in distressed assets in 2023?
Yeah, I think this was a surprise to us, at least, that such a high percentage, 48%, said that they would. I think on a given year, it wouldn't register nearly as much, as a matter of fact. So again, going with that correlation, which we discussed earlier, with seeing the year as a year of opportunity, given that and some of the points that you already raised, with the interest rate environment that you've got, it may take out a number of competitors. So that as a practical matter, with a combination of feeling, this is a year of opportunity, we're going to invest in distressed assets, and going to the next point, we don't need debt to do so. We have the capital to do so. Really, again, can give rise to both a sense of opportunity and knowing that you're going to invest in distressed assets.
Yeah, good point. I've been investing in properties, not competing with my clients, but doing a little bit here and there over my career. And, I've got properties that I remember when I bought them, you kind of think, well, am I paying a little too much? Am I paying a little too high of interest rates? And I look back and, none of that matters. They were good properties. I'm a long-term hold. Yeah, it's good to get in the properties, to your point earlier. Inflation over time, you're going to be a winner unless you really mess it up. All right, well, let's go to number 6. What will be your primary source of equity in 2023?
Yes. So again, this is a little bit of a surprise in that private equity was the big winner, 35%, relative to institutional investors at 27%. And in past years, clearly institutional investors were much higher than private equity. And when you think about private equity, if you take the lending market out of the mix, or largely out of the mix, well, if you are going to invest, you've got to have the resources to do so. Whether you already have the capital, whether you're going to identify third-party investors, whether it's private equity, hedge funds, or frankly, just the mom and pops or family and friends, or wealthy individuals. The fact is that that capital's got to come from some source, and it's going to come from non-lending sources to do so. And what we are finding, and what we have found traditionally, is if you've got capital, and if you can be an all-cash buyer, then you are going to be more likely than not, maybe not the winner on any sort of bid, but certainly within the discussion of those final bidders. So again, providing the equity that's necessary, you can do it without debt, all going to the point that if you, again, see this as a year of opportunity, which may or may not be part of this question, you're going to use third-party equity to go out and buy the property, and it's going to be private equity in 2023.
Yeah, there's still a good bit of equity out there, and while some equity providers are on a little bit of a stall, if you will, we're still seeing multiple offers on properties, and properties, frankly, selling for bigger prices than sometimes that we expected as brokers. Let's bring us to question number 7, which is an interesting one. You list the top kind of 10 issues that could be concerns for the economy and commercial real estate. And the question was, which of the following represent the greatest concerns for the commercial real estate industry in 2023?
And bottom line is here, and almost any question that you can ask the real estate community, what drives the answer? The answer is going to be fundamental. And the fundamentals here show interest rates, inflation, rising costs, and concerns of an economic recession. No surprise in terms of the big issues. It is interesting to see that concerns about supply chain have dropped from what was, I think, number 3 last year to 6. Omicron dropped to number 8. So looking at our industry, looking at our economy, clearly the fundamentals of higher interest rates, inflation, and economic recession rule the day in terms of the greatest concerns, and rightly so under the circumstances.
Yeah, it makes sense. And question number 8 is a really interesting one to me, and that's which real estate sector presents the greatest opportunity for your investment strategy in 2023?
And based on 2021, and even going back into 2020, and for those who've been in the multifamily marketplace many, many years, no surprise that multifamily it garners 31% and industrial 24%. So that's making up, if you will, 55% of the potential investment sectors. In many markets, office is just off the list. We understand in certain markets, the concerns over vacancy and effective rents are going to drive down the value of certain office product substantially. So they wouldn't be on the radar screen. And multifamily and industrial have performed well, notwithstanding that you hear about the rate of increase of rents for multifamily having stalled relative to what it's been in the past. The fact is, over the last couple of years, you can't retain 14% per year increases in multifamily rents. It just doesn't make sense. So that may be coming back down to a more realistic market-based rent increase. But the fact is, there still is third-party GSA financing. The fact is, there is a housing deficit in the United States. And with the exception of certain markets that may be overbuilt, there is a need for additional housing on many levels. What was very interesting to us in terms of the results, Michael, was not so much the multifamily and industrial are the big winners, but at least in our survey, single-family rental was at the bottom at 2%. And as you know, being in the industry, single-family rental has been the rage for the last 18 months to 2 years, certainly during what I'll call the COVID years. And that has just fallen off relative, at least to our respondents, but no real surprise. Well, I shouldn't say no real surprise. It was a surprise, given that there has been such a focus on this sector for the last several years.
Right. And you mentioned number 1 was kind of multifamily, 2 was industrial, which I think people would agree with it, or their listeners or viewers. Then you got on the list, number 3 was shopping center and retail. And then before was hotel, and then 5 senior housing. And then you got to go pretty far down the list to get to suburban office. And I think it's interesting if you believe that the cycle will change as more of these employers have the power to get employees back in their office for the benefits of those employees' careers and the company top line and bottom line numbers. And you see that so few investors are going to be interested in office, and lenders might be some real opportunities in the office world. I think it's going to be interesting to see when we look back and watch, a year or 2 years from now, what happens there. I think there could be some fortunes made, or maybe some fortunes lost. We'll see, we're going to see what we are seeing. Some of this office product going back to lenders already. You sit here on the West Coast, on the East Coast, you're seeing that happen. And so now the question is, again, if you believe it's a year of opportunity, you can go in and either buy the debt or buy these properties at a deep discount, and you can do something with them. You've got the capital to renovate them or perhaps convert them. There's a lot of discussion about converting to multifamily or other multi-uses. Real opportunity. Opportunity. Yeah, I agree. And, I think we're seeing some sellers that are realizing that even though the values have changed based on the cost of funding, they're still making a profit, right? They're still a lot of folks have a lot of equity in their properties and are moving them at prices that make sense. For example, we have a $42 million property portfolio that this can be delivered at a 9.6 cap, which also has about 80,000 square feet to lease up for value add in a market with 2.6% vacancy. So there are sellers out there that are pricing properties very, very well. I think there's going to be a lot of great opportunities. I agree with that for this year. A lot of investors I've dealt with in my 35 career, when I call them about buying properties in a hot market, Michael, it's so cute you call me. Thank you. I appreciate hearing from you. But we don't buy when the market's this hot. When the market's going down a little bit, give us a call. Those investors are going to be pulling out a lot of cash and buying property, I believe, this year. Which brings us to number 9. Will your company shift its investment sites from urban to suburban markets in 2023?
And the answer is no. The short answer is no. These numbers are substantially the same as in 2021, or 2022, excuse me. So we're looking at 74% that say, no, we're not going to look to the suburban markets. 26% said they would. And again, going to all those fundamentals that we're talking about, where are the opportunities? Still the perception is in the urban marketplace, whether it's perhaps office, mixed use, certainly multifamily. Where there is demand is where the money's going to go. And right now, the perception is it's still in the urban markets.
Yeah, that is interesting. Question number 10, has the migration to work from home / hybrid models adversely impacted your company?
And these numbers are not, again, substantially different from last year. And the focus is the culture. That's what's being affected. At least that's the perception by the response, that the culture is being substantially impacted. A good 62% say that's the number one concern as it relates to the work from home or hybrid models. They're not losing it on the bottom line. They're not losing it on loyalty per se, but culture is a whole nother story. And that was pretty much the same from last year. And anecdotally, we're seeing it as well, and something that I think employers are trying to focus on. How do we get the folks in large part to maintain that culture, assuming that your particular company is interested in a particular company culture, and that's the focus, that's the concern, and that's where all the consultants are spending their time and effort.
Yeah. Well, that makes sense. I think one of the big things that we like to have in our office is a great culture, and that's why a lot of people are here and they're loyal. They grow their business, and it's just a great environment. And I tell my employees and brokers that, look, if you're not, if you're difficult to be around or work with, you're not client oriented, don't come here. That's not our culture. And it's interesting, if you're hiring new folks and you're going to love our culture, well, you're going to be at home. You're not going to really meet anybody, but you'll love it anyway. That is interesting. Which brings us,
and you could take it. You could take a different position. Hey, my bottom line's actually pretty good with you being at home. Yeah. That's not the point. That's not the entire point.
Right.
We want in here because we want to create that culture, and frankly, for your more junior folks to understand what it's like to be in a culture that is conducive to work.
Right. Question number 11, and it works the same, right along there. How often do you expect to be in your company's office space on a weekly basis?
Well, if you're a commercial real estate executive, 55% expect to be in 4 to 5 days a week, which is high, given that we think, I don't know what the current number is, but I think in the DC marketplace, occupancy is about 41%. In some cities, it's up to 54% based on stuff that I've read, but it's much less, and that's not in 4 to 5 days a week. That's in on any given day. So to get to 4 to 5 days per week, that's a pretty high percentage, 55% of these professionals. And that's my expectation, Michael, is that the respondents are not your administrative staff, if you will, to our survey. They are professional executives. So they're looking at it top down, and that would not necessarily express the sentiment, if you will, of more administrative staff, more junior staff, and we'll see who wins out at the end of the day.
Yeah. And number 12 is kind of an interesting question. It's about which government policy would spur the biggest increase in development of real estate. And some of the options were lowering of interest rates, tax credits and incentives, and rezoning, government investment in infrastructure, What were the respondents saying?
Yeah, not too shocking. Lower the interest rates. That's going back to the fundamentals. Look, you get our interest rates lower, we'll invest. And every year we try to take into account what's happening, whether it's a political year, there's a presidential election, or some other event, which we try to take into account here, with the expectation that there would be some effect on our industry, given interest rates, et cetera, et cetera. We did ask this question, and the reality is, here and in the next question, I believe that we're going to get to, the fundamentals to take place, to take precedence. It's lowering interest rates. That's what 70% of the respondents think is necessary in order to spur, we'll say, development, but it's also investment.
Yeah, well, it makes sense. And the final question, number 13, is an interesting one. It's, which state government policy do you think will be the greatest driver of corporate office relocations in 2023? And I know we help companies in the Southeast with their office or their industrial uses, and a lot of them coming from, I don't know, the Northeast and other areas coming to the Southeast. So it's a very interesting question to me personally. And some of the options were low state taxes, limited regulation, policies regarding reproductive rights, policies regarding ESG and electronic vehicle incentives and mandates. What do the respondents say?
Well, overwhelmingly, low state taxes, and then after that, limited regulation, which again, in the real estate business, neither one of them is surprising, and maybe business generally. But we thought we'd add some of the social-oriented policies to see what effect, if any, they would have on some of these decisions, and clearly, again, driving the fundamentals. Get me low interest rates, get me low state taxes, limit the regulation of my business, and I will invest, and I will prosper. So no real surprise there. And again, every year, many of these questions just go right to the bottom line. What are the fundamentals of our industry, and how are they best protected?
Yeah. Well, it's an interesting report and survey, and I love the takeaways that you shared with us, Ron. What would be a final thought for our listeners regarding the report this year from you?
Well, notwithstanding that the report came out, if you will, in mid-February, I think many of the responses are going to hold true for the balance of 2023, from interest rates to having lower state taxes. That's fundamental, but the other items as well. I think you will see a resurgence of this sector. Certainly the expectations of the third or fourth quarter, as interest rates either moderate or stabilize, and people can make decisions based on some understanding of what the current marketplace is on a stabilized basis. And that also, I think, results in perhaps cap rates changing, sellers becoming more realistic if they do want to sell, and having their prices come down, so that gives rise to those with capital going out and performing on their budgets and on their operating business plans.
Great. Ron, great information. Thank you for joining us, sir.
Thank you for having me. Greatly appreciate it.
All right. If you want more from their website, is Seyfarth.com. We appreciate you listening or watching the show. Hey, please share the show if you will. Please connect with us on your favorite social media and reach out if we can help you in any way. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.